The former IndyMac Tower in Pasadena, California, a 21-story office building once valued at $160 million, just sold at auction for $16 million. That is a 90% decline in asset value on a property that was considered institutional-grade real estate less than a decade ago. This is not a distressed rural property in a declining market. This is a Class A office tower in a major metropolitan corridor of the second-largest city in the United States. And it is not an isolated transaction. It is a data point in a pattern that is now repeating itself in Dallas, Denver, Chicago, and Atlanta, with increasing frequency and increasing severity. The financial press describes these sales as one-off distress events, anomalies that do not reflect the broader market. That framing is incorrect. These are not anomalies. They are leading indicators of a repricing cycle that is only in its second inning, carrying losses that the regional banking system has not yet been forced to recognize. What is unfolding in commercial real estate right now is not a correction. It is a structural solvency event moving in slow motion through the balance sheets of over 700 regional banks that collectively hold $1.8 trillion in commercial real estate exposure. The number you need to understand is not 10%. It is not 30%. The realistic markdown on distressed office assets in major American cities is running between 60 and 90 cents of value destruction on the dollar. Apply that range across the commercial property market, and you are looking at a capital hole that is roughly 4 times the size of the losses that triggered the 2008 financial crisis. The difference this time is that the losses are not concentrated in the trading books of Wall Street investment banks. They are distributed across the loan portfolios of community and regional lenders in every state in the country. Banks whose names you have never heard of. Banks whose failure would freeze credit in your city. What you are watching is a system tightening from the inside out, not a crash. A structural repricing event moving at the speed of loan maturities, not headlines. To understand how this happened, you have to trace the incentive structure that produced it. The Federal Reserve held the federal funds rate near zero for the better part of 14 years, from 2008 through early 2022. That policy decision was designed to stimulate economic recovery, but it had a secondary effect that no one in the mainstream is willing to discuss plainly. It created the longest and most distorted commercial real estate bubble in the history of American finance. When capital costs nothing to borrow, every yield-producing asset becomes attractive regardless of its underlying fundamentals. Developers borrowed cheap, built aggressively, and underwrote future cash flows using assumptions that only made sense in a zero-rate world. Office buildings were leased on long-term contracts to corporations who had not yet reckoned with a remote workforce. Retail centers were financed against tenant rosters that assumed e-commerce penetration would plateau. Apartment syndicators raised capital from retail investors using pro formas that projected 20% annual rent growth compounding indefinitely. These were not fraudulent projections at the time they were made. They were rational extrapolations of a policy environment that had no historical precedent. The problem is that the policy environment changed, and when it changed faster than any model predicted. Between March 2022 and July 2023, the Federal Reserve raised interest rates by 525 basis points in the most aggressive tightening cycle since Paul Volcker. A commercial real estate loan originated at 3.5% in 2019 now refinances at 7.5% or higher. That is not a marginal change in debt service costs. On a $50 million loan, that shift adds approximately $2 million per year in interest expense. For a building already operating with compressed margins due to vacancy and rising operating costs, that additional burden is not absorbable. The math is simply closed. The building generates less income than its debt requires, which by any definition makes it insolvent. The question is not whether these properties are insolvent. The question is when the banking system is forced to admit it. The mechanism that is delaying that admission has a name. It is called extend and pretend. When a commercial real estate loan matures and the borrower cannot refinance at market rates, the bank has 2 choices. It can foreclose, take the property onto its books, and realize the loss immediately. Or it can grant the borrower a loan modification extending the maturity by 12 to 24 months in exchange for a partial paydown or a higher rate, hoping that conditions improve before the extension expires. Banks are overwhelmingly choosing the second option, not because they believe conditions will improve, because recognizing the loss today triggers capital adequacy requirements that many of them cannot meet. The Federal Reserve Bank of New York estimated in late 2024 that if regional banks were required to mark their commercial real estate books to current market prices, approximately 385 institutions would fall below minimum capital thresholds. That is not a projection designed to alarm. It is an accounting observation about the gap between book value and market value. The gap exists. The question is what closes it and at what speed. The maturity wall is closing it whether the banks cooperate or not. Over $950 billion in commercial real estate loans are scheduled to mature in 2025 and 2026 alone, according to data compiled by the Mortgage Bankers Association. That figure represents the single largest two-year refinancing wave in the history of the asset class, and it is arriving at a moment when the lending market for commercial real estate is functionally frozen. Major insurance companies, which historically provided a significant share of permanent commercial mortgage financing, have pulled back sharply from the office and retail sectors. CMBS issuance, the securitization pipeline that funneled Wall Street capital into commercial property loans, has contracted to levels not seen since 2012. Private credit funds stepped into the gap briefly, but they are now gating withdrawals as their own portfolios deteriorate. The capital that was available to refinance this wall of debt simply does not exist at the scale required. What happens when a borrower cannot refinance and the bank cannot afford to foreclose? The asset enters a legal and financial limbo that can last for years, slowly degrading in value while the underlying loan festers on the bank's books. This is the precise dynamic that produced Japan's lost decade following its commercial real estate bust in the early 1990s. Japanese banks refused to recognize losses for a decade, maintaining zombie loans on zombie buildings, effectively allocating capital to dead assets rather than productive new lending. The result was a prolonged credit contraction that suppressed economic growth for an entire generation. The United States is replicating this dynamic with American institutional characteristics. The difference is that American banks operate in a mark-to-market accounting environment with active regulators who are, slowly and reluctantly, beginning to enforce transparency. The Office of the Comptroller of the Currency issued updated guidance to national banks in late 2024, instructing examiners to scrutinize loan modifications more aggressively and to require appraisals on extended commercial real estate loans rather than accepting the original valuations. This regulatory shift is quiet but consequential. It removes one of the primary tools that banks have used to delay recognition of losses. When a bank is forced to obtain a current appraisal on a modified loan, and that appraisal reflects current market conditions, the loss emerges on the balance sheet. Capital must be set aside. If the capital is insufficient, the bank must raise equity or reduce its loan book. Neither option is attractive. Both produce contractionary pressure on local credit markets. The sector breakdown of these losses matters because different property types are deteriorating at different rates and through different mechanisms. Office is the most acute problem. National office vacancy reached 19.8% in the fourth quarter of 2024, according to CBRE, surpassing the previous all-time high set in the early 1990s. In San Francisco, vacancy sits above 36%. In downtown Houston, it exceeds 28%. In Chicago's Central Business District, it has crossed 25% for the first time in the city's recorded commercial history. These are not temporary dislocations caused by cyclical economic weakness. They reflect a permanent structural shift in how corporations use physical space. The hybrid work settlement that emerged from the pandemic has reduced average office utilization rates to roughly 50% of pre-pandemic levels in most major markets. Corporations are not leasing less space because the economy is weak. They are leasing less space because they have discovered that productivity does not require 5 days per week of physical co-location. This demand destruction is structural, not cyclical. It does not reverse when the economy improves. It deepens as leases roll over and companies right-size their footprints to match actual utilization. The implication for property values is not a 15 or 20% haircut. In markets with high vacancy and high operating costs, the income capitalization math produces values that are 50 to 80% below the peak. This is because commercial real estate values are not primarily driven by sentiment or comparable sales the way residential property is. They are driven by net operating income divided by a capitalization rate. When income falls because vacancy rises, and when capitalization rates expand because risk premiums increase, the two forces compound against each other. A building that generated $8 million in net operating income at a 5% cap rate was valued at $160 million. If that same building now generates $3 million in net operating income due to vacancy, and the market cap rate has expanded to 7.5% to reflect higher interest rates and higher risk, the building is now worth $40 million. That is a 75% decline in value from a relatively moderate set of assumptions. Apply that math across the $2.4 trillion U.S. office market, and the capital destruction is not in the billions, it is in the trillions. The banks holding the loans against these assets are the transmission mechanism through which this loss reaches the broader economy. Regional banks, defined as institutions with between $10 billion and $100 billion in total assets, hold disproportionate concentrations of commercial real estate exposure relative to their capital bases. The Federal Reserve's own stress testing data indicates that for some regional institutions, Commercial real estate loans represent more than 300% of their total risk-based capital, 3 times their capital buffer secured by a single asset class that is currently experiencing the deepest and most geographically broad price decline in its recorded history. When the losses on those loans exceed the capital buffer, the institution becomes insolvent. The FDIC steps in, deposits are protected up to the insurance limit, and the assets are sold at a discount that crystallizes the loss permanently. The depositor is protected, the shareholder is wiped out, the bondholder takes losses, and the local economy loses its primary source of small business credit. The residential housing market is absorbing a second set of structural pressures that are separate from, but interconnected with the commercial collapse. The lock-in effect that has dominated housing market analysis for the past 3 years is beginning to fracture. An estimated 60% of outstanding mortgage balances in the United States carry rates below 4%, according to Federal Housing Finance Agency data. Homeowners with those mortgages face a severe financial penalty for moving. Selling a home financed at 3.25% and buying a comparable home at a 7.25% rate on a similar loan balance increases monthly payments by approximately $100. That penalty has effectively frozen the existing home sale market, suppressing inventory and creating an artificial price floor. But the freeze is not permanent. Life events that economists refer to as the 4 Ds, death, divorce, debt, and displacement through job loss, force asset sales regardless of mortgage rate differentials. Data from the National Association of Realtors shows that existing home inventory in markets like Austin, Phoenix, Denver, and Nashville increased by 18 to 22% in the first quarter of 2025. This inventory accumulation is not being matched by demand. Mortgage purchase applications in early 2025 are running at levels last seen in 1995, adjusted for population. The buyer pool at current rates and current prices is structurally insufficient to absorb the supply that is entering the market. The affordability mathematics explain why. The median monthly mortgage payment on a median-priced home in the United States crossed $2,800 in 2024, including taxes and insurance. For a household earning the median income of approximately $78,000, that payment represents 43% of gross income. Conventional mortgage underwriting standards define affordability at 28% of gross income for housing costs. The market is not slightly above that threshold, it is 54% above it. The population of households that can qualify for a mortgage on a median-priced home at current rates has contracted to approximately 16% of all American households. In 2019, that figure was 44%. The demand destruction is not marginal, it is comprehensive, and without demand, prices do not maintain themselves regardless of how restricted supply appears to be. The insurance market is adding a cost layer that most housing market analysis completely ignores. Between 2020 and 2024, homeowners' insurance premiums increased by an average of 33% nationally, according to the Insurance Information Institute. In Florida, average premiums rose by more than 100% over the same period. In California, in the areas where coverage is still available, increases of 50 to 80% are common. In Louisiana, Mississippi, and coastal Texas, insurers are simply exiting the market rather than pricing the risk. State Farm announced the non-renewal of 72,000 policies in California in early 2024. Farmers Insurance exited Florida entirely. When private insurance retreats, homeowners are forced into state-backed insurers of last resort that carry lower coverage limits and higher deductibles. For a property owner with a mortgage, the inability to obtain adequate hazard insurance is not an inconvenience. It is a loan covenant violation. Without insurance, the mortgage is in technical default. This mechanism is adding a third dimension to the affordability crisis that is not captured in median payment calculations. A homeowner who purchased their property with a 3% mortgage and whose payment is theoretically affordable is now facing an insurance bill that has tripled. Their all-in housing cost has increased by $400 to $800 per month through no decision of their own. This is the hidden repricing that is pushing households that appeared stable into financial stress. The property tax component amplifies this pressure further. Because assessed values in most jurisdictions follow transaction prices with a 2 to 3 year lag, property tax bills in 2025 are still reflecting the peak values of 2022 in many markets. A home purchased for $350,000 in 2019 that was reassessed to $520,000 based on the 2022 peak may face a property tax bill that is 40% higher than it was 5 years ago. In states without assessment caps, this repricing is immediate and mandatory. The homeowner receives a higher tax bill whether the current market value supports it or not. For retirees on fixed incomes, this dynamic is particularly acute. Social Security cost of living adjustments do not move in proportion to local property tax increases. Households that paid off their mortgages decades ago and considered themselves financially secure are now facing the functional equivalent of a new housing cost obligation through the tax system. Hardship exemptions and appeals processes exist in most jurisdictions, but they require documentation, legal knowledge, and persistence that many elderly homeowners do not have access to. The institutional investor angle adds a layer of market distortion that is now beginning to reverse. Between 2020 and 2023, institutional single-family rental platforms acquired approximately 500,000 homes in the United States, concentrated in Sun Belt markets. Invitation Homes, AMH, and Pretium Partners built portfolios at prices justified by a combination of cheap financing, expectations of continued rent growth, and assumptions about permanent housing supply constraints. All three of those justifications are now under pressure simultaneously. Financing costs have doubled, rent growth has stalled or reversed in Phoenix, Austin, Jacksonville, and Charlotte as new apartment supply hit those markets in volume, and the supply constraint narrative is being complicated by rising inventory in exactly the markets these platforms concentrated their acquisitions. The yield math for these portfolios no longer works at current interest rates. Cap rates on single-family rental assets in major Sun Belt markets are running between 4.5 and 5.5%, against a cost of capital that is 7% or higher for most institutional borrowers. Negative leverage of this magnitude means the assets are generating less cash than the debt costs to carry them. The rational financial response to negative leverage is to reduce exposure. Institutional disposition of single-family rental properties has been accelerating since mid-2024. When 500 homes in Phoenix enter the resale market from a single institutional seller in a quarter, it adds supply to a market that is already inventory heavy. The price discovery that follows is not gradual, it tends to be abrupt. The municipal finance dimension of this crisis is perhaps the most underappreciated risk in the system. Commercial properties in major American cities typically generate 30 to 45% of total property tax revenue for their host municipalities. As commercial valuations decline and as property owners appeal their assessments, that revenue stream compresses. New York City's Independent Budget Office estimated in early 2025 that commercial real estate value declines could reduce annual property tax revenues by $1.4 billion by 2027 under moderate stress scenarios. Chicago faces a structural pension funding gap that already requires aggressive property tax growth to meet its actuarial obligations. San Francisco, where office vacancy exceeds 36% and where major technology employers have reduced their footprints dramatically, projected a $790 million general fund shortfall for fiscal year 2025. These are not budget management problems. They are structural fiscal failures driven directly by the repricing of commercial real estate. When municipalities face revenue shortfalls of this magnitude, the response is some combination of service reductions, tax increases, and debt issuance. Service reductions accelerate the negative feedback loop by making the city less attractive to the businesses and residents that form the tax base. Tax increases on remaining property owners and businesses raise the cost of operating in the jurisdiction, incentivizing relocation. Debt issuance, if the municipality's credit rating is deteriorating, occurs at higher rates, compounding the long-term fiscal pressure. Municipal bondholders who view these instruments as safe fixed income assets are carrying risk that is not reflected in current spreads. The regional bank contagion path connects all of these pressures through a single channel. When commercial real estate losses force a regional bank to raise capital or reduce its loan book, the tightening is felt immediately in the local credit ecosystem. Small businesses that rely on revolving lines of credit from community banks to manage cash flow find those lines frozen or reduced. Real estate developers who need construction financing to complete projects find the window closed. Local governments that issue short-term tax anticipation notes to bridge seasonal revenue gaps encounter higher borrowing costs or reduced appetite from their traditional banking relationships. This is not a Wall Street problem that stays in Wall Street. It is a Main Street credit contraction that slows hiring, delays investment, and reduces the tax revenue that funds public services. The Federal Reserve's Senior Loan Officer Opinion Survey has tracked a steady tightening of commercial real estate lending standards since the first quarter of 2023. By late 2024, net tightening in this category was running at levels that historically correlate with recession conditions in the broader economy. The derivatives and structured finance exposure adds complexity that the public narrative consistently underestimates. Commercial mortgage-backed securities, the bonds created by pooling commercial real estate loans and selling them in tranches to institutional investors, have been reporting delinquency spikes that are becoming difficult to ignore. The CMBS delinquency rate for office properties crossed 10% in late 2024, according to TREP data, the highest level since the immediate aftermath of the global financial crisis. The subordinate tranches of these securities, the bonds that absorb losses first, have been trading at distressed levels for months. The senior tranches, which were rated AA at issuance based on stress scenarios that did not contemplate 30% plus vacancy rates, are beginning to see credit events that were not modeled as probable. Insurance companies, pension funds, and money market adjacents that purchased these instruments as investment-grade fixed income are carrying impairments that have not been fully recognized. The opacity of the structured finance market, where valuations are model-based rather than transaction-based, means that the full extent of these losses remains invisible until a liquidity event forces price discovery. The credit default swap market is beginning to price this risk more explicitly. Spreads on the debt obligations of regional banks with high commercial real estate concentrations have widened materially since mid-2024. This is the market's way of charging a higher premium for the risk of holding these institutions' liabilities. When credit default swap spreads widen on a bank, it signals that professional credit market participants, the people whose job it is to price institutional credit risk, are revising upward their probability of a credit event at that institution. This is not a retail investor panic. This is institutional risk repricing based on fundamental loan portfolio analysis. It is the mechanism through which the commercial real estate crisis begins to be transmitted into the broader credit market. The labor market feedback loop completes the circuit. When commercial real estate distress forces regional banks to tighten credit, small and medium-sized businesses lose access to the financing they need to maintain operations and employment levels. Small businesses employing fewer than 500 people account for approximately 46% of private sector employment in the United States. They are not financed by Goldman Sachs. They are financed by the regional and community banks that are most exposed to commercial real estate losses. A credit contraction at this level of the banking system produces employment stress that does not show up immediately in headline jobless claims because it manifests as slower hiring, reduced hours, and the attrition of positions rather than mass layoffs. The BLS Household Survey captures this deterioration before the payroll survey does, and the divergence between these two measures has been widening since late 2024 in a pattern that historically precedes a recognized recession by 6 to 9 months. What happens next is not a prediction. It is a description of the mechanical process already in motion. The $950 billion maturity wall does not care about soft landing narratives. Each loan that reaches maturity in 2025 and 2026 requires a resolution. Extend and pretend has a limit defined by the regulator's patience and the bank's capital position. As regulators tighten appraisal requirements and as capital constraints prevent indefinite extension, the properties will begin entering distressed sale or foreclosure processes at increasing volume. Transaction volume in the distressed commercial real estate market is a leading indicator of price discovery. When transaction volume increases, price discovery accelerates. When price discovery accelerates, the gap between book value and market value narrows. When that gap closes on bank balance sheets, capital adequacy calculations change. Banks that are marginally capitalized today become undercapitalized when the market forces them to mark their portfolios honestly. The Federal Reserve faces a policy constraint that it has not publicly acknowledged. Cutting interest rates to relieve refinancing pressure in commercial real estate would reduce the incentive for institutional capital to hold U.S. Treasury securities, which are currently competing favorably with risk assets because of elevated yields. A rate cut cycle aggressive enough to meaningfully improve commercial real estate refinancing economics, say 200 to 250 basis points, would also reignite inflationary pressure in the goods and services economy that the Fed spent the last 3 years suppressing. The Fed cannot simultaneously maintain price stability and prevent a commercial real estate credit crisis. It is choosing, by inaction, to allow the credit crisis to continue developing while preserving its credibility on inflation. That is a defensible policy choice, but it has consequences that are distributed unevenly across the economy, concentrated in the regions and institutions most exposed to commercial property. The insurance market withdrawal from coastal and high-risk properties creates a feedback loop into residential real estate values that operates entirely independently of interest rates. A property that cannot be insured at an affordable premium cannot support a mortgage. A property that cannot support a mortgage can only be purchased with cash. The population of cash buyers is limited and price sensitive. Therefore, in insurance retreating markets, the effective demand floor is set by cash buyer willingness to pay rather than by mortgage market affordability. Cash buyers in distressed markets typically require yields that imply purchase prices 25 to 40% below insured market comparables. This dynamic is already playing out in parts of coastal Florida, where homes listed at $500,000 are receiving cash offers at $300,000 from investors who have priced in insurance costs and the absence of financing. As insured comparables reprice downward to reflect this dynamic, The collateral value supporting existing mortgages declines. Lenders hold loans secured by assets that are worth less than the loan balance. Homeowners hold equity that exists only on paper. The migration pattern data reveals the geographic dimension of this repricing. Interstate migration flows tracked by the U.S. Postal Service and confirmed by IRS income migration data show a persistent movement of high-income households from California, New York, Illinois, and Massachusetts to Florida, Texas, Tennessee, and North Carolina. This migration is not primarily tax-motivated, as popular analysis suggests. It is increasingly insurance and cost-motivated. A household leaving San Francisco is not primarily fleeing the state income tax rate. They are fleeing a $4,200 monthly mortgage payment on a 900 square foot condominium, a $6,000 annual insurance premium that State Farm will not renew anyway, a property tax bill that has doubled, and an electricity rate that is 3 times the national average. The receiving markets are absorbing this influx with varying degrees of stress. Nashville's housing market, for instance, has seen median prices appreciate more than 60% since 2019 on the back of net population inflows from higher cost markets. This creates a geographic concentration of affordability pressure even in markets that were previously considered relatively accessible. The energy cost dimension compounds housing stress in ways that do not appear in mortgage default statistics because they manifest in household cash flow before the mortgage payment is missed. The average American household spent $3,600 on electricity in 2024, a 44% increase from 2019 according to the Energy Information Administration. In California, the average residential electricity rate hit 32 cents per kilowatt hour, more than 3 times the national average. Households in the Northeast face a structural energy premium driven by pipeline constraints and grid reliability issues that we have documented separately. When electricity costs increase by $200 per month for a household already allocating 40% of gross income to housing, the marginal cash flow available for debt service, car payments, and consumption simply compresses. This household is not in default today, but its financial resilience has declined materially, and its sensitivity to any income disruption has increased sharply. The process that is unfolding does not have an imminent resolution point. The maturity wall continues through 2026. Regulatory tightening of extend and pretend practices continues to increase the speed at which losses surface. Insurance market withdrawal from high-risk geographies continues to compress collateral values in those markets. Migration patterns continue to redistribute population pressure in ways that strain receiving markets. Municipal revenue shortfalls continue to accumulate. Credit standards at regional banks continue to tighten. Each of these processes is running concurrently, and they are reinforcing rather than offsetting each other. What breaks first is not deterministic. It depends on the sequence of specific credit events and policy responses. If a cluster of regional banks with high commercial real estate concentrations are forced to raise capital simultaneously, the equity dilution and potential FDIC resolution creates a confidence event that accelerates deposit movement from weaker to stronger institutions. If a major CMBS trust triggers an event of default on a pool of office loans and the servicer is forced to sell assets at distressed prices, the transaction data enters the market and reprices comparable assets in every other portfolio that holds similar exposure. If a large municipality issues debt at a meaningfully higher spread due to commercial real estate-driven revenue concerns, the revaluation of municipal bond portfolios creates mark-to-market losses for the institutional holders of those bonds. Any of these events can be the catalyst that converts a slow structural repricing into a faster recognition event. None of them are guaranteed on a specific timeline. All of them are mechanically probable, given the underlying conditions. The process is still unfolding. The maturity wall has not fully run. The regulatory tightening has not fully enforced. The insurance repricing has not fully transferred to mortgage collateral values. The municipal revenue shortfalls have not fully hit bond markets. The data will clarify the sequence and the severity as each of these mechanisms works through the system. What is already clear from the existing data is that the commercial real estate correction that began in 2022 is not a cycle that is approaching a bottom. It is a structural repricing of an asset class that was mispriced for a decade by a policy environment that no longer exists. The buildings are not going anywhere. The debt secured by those buildings is. And the institutions holding that debt are carrying losses that have not yet been fully counted. Watching the count is the work of the next several years.